All right, let's dive in. Today, we're putting the industrial giant 3M under the microscope. We're going to break down a detailed analysis to figure out if this iconic company is a massive opportunity or maybe more of a financial landmine. Let's get into it.
So this is the big question, right? Is 3M a golden opportunity hiding in plain sight, or is it one of those classic value traps that looks good on the surface but isn't? Well, that's exactly what we're here to figure out.
Okay, let's just start with the number on the ticker. At the time of this analysis, 3M stock was trading for $167 a share.
But, and this is a big but, the analysis calculates the company's real worth, its intrinsic value, based on all the fundamentals at just $102. Whoa, that is a huge gap between the market price and what the business might actually be worth.
So right off the bat, the verdict is in. The stock is considered overvalued. The rest of this breakdown is all about the why. How did the analysis get to that conclusion? Let's dig in.
First things first, we've got to understand the business itself. We'll take a look at what 3M actually does, and more importantly, the serious headwinds it's sailing into right now. So, what is 3M really? Well, at its heart, it's an innovation powerhouse in material science. They're the brains behind all sorts of unique materials. Adhesives, abrasives, complex filters. And then they take that science and bake it into thousands of different products. We're talking everything from the Post-it notes on your desk to high-tech gear used in hospitals.
And this right here, really gets to the core of the conflict. Historically, 3M was a beast. It was all about patent-driven innovation, and they were woven into the very fabric of industrial demand. But today, that story is a bit different. They're facing some serious headwinds, namely massive litigation risk and slowing, even declining, top-line growth.
All right, time to deconstruct the numbers. This is where the rubber meets the road. We're moving beyond the headlines to see what the financials are really telling us about the company's health.
And, check this out. This is a big one. Free cash flow. Over the last 12 months, it was only $1.4 billion. Now, you compare that to the 5-year average, which was over $3.3 billion. That's a huge drop, and it's a major red flag for declining earnings quality, probably tied to that slowing growth we just mentioned.
And if that last slide didn't make it clear, this quote really hammers it home. The company paid out $1.56 billion in dividends, but only generated $1.4 billion in free cash. Think about that. They're paying out more cash than they're bringing in. You just can't do that forever, and it puts that famous, reliable dividend in some serious jeopardy. Okay, but it's not all doom and gloom. Let's look at a bright spot. Their recent return on invested capital, or ROIC, which is basically how good they are at turning money into more money, is nearly 18%. That's pretty good. It suggests some of their restructuring efforts are actually paying off, but that bright spot is a little dimmed by a much weaker 5-year average of just under 6%, so it's a mixed signal.
And the list of worries continues. Here are a few more key red flags the analysis points out. A high debt-to-equity ratio of 2.68. That means a lot of leverage. A negative 5-year revenue growth rate. And then the two elephants in the room we keep coming back to, massive litigation liabilities and an underfunded pension. It's a challenging picture, to say the least.
So, with that financial picture in mind, what does the future hold for 3M? Well, this next part explores the potential outcomes. We're going to analyze a few different scenarios and balance the company's strengths against its pretty significant risks. Now, this weighted SWOT analysis is incredibly revealing. Just look at this. Litigation risk carries the heaviest weight at 20%, but it gets the lowest possible score, a 1. That one single factor is like an anchor, just dramatically dragging the company's overall score down. It shows you just how central that one issue is to the entire investment case.
So this chart lays out the range of what could happen. In a bear case, with all the legal issues dragging on, the value could be as low as $82. The base case, our $102 figure, assumes things kind of stabilize. And then there's the bull case, where the legal problems get resolved and the value could hit $128. But here's the key takeaway. Even the most optimistic scenario is still significantly below the current market price. This brings us to a key question for any investor. What's the right price to buy? So now we're going to get actionable. We're going to talk about specific entry points. But as we'll see, the right price really depends on your individual investment goals. This table provides a super clear framework. It shows the price you'd need to pay to get a specific annual return over 16 years. So, if you'd be happy with a 7% return, a buy price of $120 is indicated. But if you want a more aggressive 10% annual return, you'd need to buy in way down at $85. It's a direct link between the price you pay and your potential performance.
And it's not just about your return target, it's also about your time horizon. This second table fixes the desired return at 9% and shows how your buy price changes depending on how long you plan to hold the stock. The longer your time horizon, the lower your entry price needs to be to hit that same 9% goal.
Okay, let's pull all of this together. What's the final takeaway? What's the clear, actionable strategy here?
Here's why the analysis believes the stock is mispriced. It seems like the market is being a little too optimistic, pricing the stock as if those huge legal liabilities are already in the rearview mirror. And because of that, the current price doesn't really compensate investors enough for the significant risks involved.
Which brings us right back to the final verdict from the analysis: a hold. Not a sell necessarily, but certainly not a buy at the current price.
So what's the recommended game plan? Well, it's laid out here in 4 pretty clear steps. Step 1, just avoid buying above $100. Step 2, an entry price below $95 gives you a much better shot at that 9% annual return. On the upside, if it runs to $175, maybe consider trimming your position, and if it hits $190, maybe think about selling completely.
So, if you remember just one thing from this entire explainer, let it be this. The analysis shows that 3M's true value is significantly lower than its stock price today. And the 2 big reasons are those looming litigation risks and that deteriorating free cash flow we saw earlier.
And that's our deep dive on 3M. I really hope you found this breakdown useful. Now, we want to hear from you. Which company's stock should we put under the microscope next? Drop your suggestions in the comments below.